Hi, I'm Shae Russell, editor of the Daily Record in Australia, and I thought we'd take a quick look at the retail sector today. Now, the reason why I wanted to look at the retail sector is because it's my personal favourite sector to analyse, but also too, you're a consumer first and an investor second. Now, there's been basically over the past couple of years an onslaught of fashion brands and local brands that we all know going into administration. So company brands like David Lawrence, Marks, Payless Shoes, Rod and Gun, Topshop, and even Surf Stitch to some example have all fallen on hard times and pretty much all gone into the hand of administrators and bankruptcy. Another one of those companies to join is Oroton. Now, Oroton is place themselves as affordable luxury. Now, in November last year, they filed for administration. It probably came to no surprise to investors that do follow the company, simply because there's been some bad investment decisions along the way since they lost the Ralph Lauren licensing agreement in Australia. However, what has been interesting is how the company is probably going to trade out of administration. And it also might actually set the tone for retailers in Australia over the next few years. So it turns out that the company is the company is going, or has, it's sort of a bit of a rumor, has negotiated lower rents across all of their 60 stores. So it means that their poor performing stores are probably paying much less rent than they were before, whereas the better stores are probably getting a tiny bit of a reduction. Now, again, the rumor has it that it was around a 40% reduction in rents that the fund manager wanted. Whether he got that or not, I don't know. It would be wrapped up in ironclad legal agreements. However, what this does mean is that Oroton could not have achieved this without the protection offered by going into administration. However, it almost might actually set a new trend going forward for some of the Australian retailers falling on hard times. When companies are looking at going bankrupt, obviously large shopping centres aren't going to want to lose all of these stores out of their business at once. So it might actually put some of the power back into some Aussie retailers. One person who might take advantage of this strategy could be Solomon Lew. Solomon Lew is the chairman of Premier Investments, and he owns some of the more recognisable brands in Australia like JJ's, Just Jeans, Jackie E, Dotty. These are all companies that fall under the Premier Investment brands. Now, he has threatened for years that the rents are too high and he'll close down stores with large shopping centres that won't negotiate. So what we could see going forward over the next few years is retailers that do fall into administration pushing for much, much lower rents. And that'll also have a flow-on effect to other companies when it comes time to renegotiate their lease. There's a chance that they'll just push for lower rents and lower rents. What this does mean for investors is that shopping centre stocks particularly, they might start to report slower revenue growth. So companies like Scentre Group, Vicinity, Mirvac to some extent, they might actually start seeing revenue reduce as more and more retailers push for lower growth. Now, why the obsession with the retail market? Well, simply put, in Australia, 56.8% of our gross domestic product comes from consumption. So what happens in how we consume things very much tells us what's going on in the economy. So if consumption starts to fall, things might not be as rosy in the Australian economy as people would have you think. That's all from me today. If there's anything you'd like to talk about, make sure you comment below. Otherwise, I'll see you later in the week. Thanks.